Okay, it's 10:40 Monday morning on the East Coast here. This is the third time I've done this video, which is unusual. I'm getting phone calls repeatedly interrupting me or making a big noise in the background. Um, I'm going to ignore them from now if I get more calls because I just want to get this video done for you. So we're going to do Chapter 11, we're going to do Week 11 and Week 12, okay? About Week 11, I appreciate that there was more participation in the discussion forums. That's good. Let's try to finish up the course here as strong as possible, okay? In Week 12, we're going to continue our discussion of managing risk. Basically, how do you set up controls in your organizations so that you minimize and/or eliminate theft, right? And so we'll have 3 chapters here in CO. One has to do with setting up the internal control system. That's Chapter 3. Chapter 4 has to do with managing your audit, making sure that you get the most out of the audit process as you can in terms of looking at your financial systems and then actually looking at the financial data that you're generating. And then in Chapter 14, it has to do with managing risk. Essentially, there are losses that occur in an organization that you really can't control. They talk about fires and stuff like that. Also, sometimes you lose major revenue sources. What are you going to do? So, a good chapter there on that as well. Okay, but what I do want to just kind of highlight is that, to me, this notion of managing risk in terms of managing theft really comes down to 3 basic strategies or good practices. And the first is that you need to build a financial organization so that there are lots of eyes, lots of people responsible for looking at various aspects of your organization's financial health. It starts with the board, so your board members need to be financially literate. They need to know how to read, the revenue and expense budgets. They need to understand the financial statements. The financial statement, what is it called? Financial statement of activity, statement of financial position, right? The balance sheet. They need to be able to understand the statement of financial activity and then cash flow, right? That's why if you're a nonprofit of any size, you really should have a finance committee. People who really enjoy and really understand the details of financial information. Maybe also an audit committee so that you do get the most out of your audit as possible, as Co says here in Chapter 4. And it also then involves all of your senior management team. Clearly the executive director, the chief financial officer, but what sometimes get left out are all the VPs in charge of all the operational aspects of your organization, and even below them, if it's a really big organization, the various program directors who are responsible for making sure that their expenditures and their programs don't go over budget. So all of these people should be involved in the financial monitoring of your organization, right? The board, again, should set the financial policy. Everybody else should be involved in fleshing out that policy and then monitoring it. And if you have lots of eyes watching everything and having regular discussions about how everything's going, then you should be able to detect things when things aren't quite on the up and up. That's how, as I mentioned in my discussion post last week, we identified the program director at the group home who was buying stuff that was not for the program. Okay? Okay, so that's the one thing. Set up a good financial structure and organization within your nonprofit organization. Secondly, and Coe talks a lot about this, I guess, in chapter 3 here, is that you set up policies and procedures that have lots of I's and double checks whenever a financial transaction is being made, right? That's why whenever there's a procurement or a bill being paid, right, you have at least 2 people authorizing the payment of the bill or the request for the bill, right? And you know why you have examples where when the money comes in or the mail comes in, right, you have more than one person who is responsible for recording that. And then also, as Coe talks about, you make sure that people who aren't responsible for the same sort of line of financial decision making, so that with that sort of authority crisscrossing across the organization, you don't have one person who can basically control all the information and thereby easily manipulate that information to cover up stealing going on. Okay? And then so the third leg of the stool then is record keeping. You need to have a chart of accounts and a record keeping system that has enough detail to it that that it provides you useful information and therefore is and that also is accurate. Okay, and then so if you have those good records recording in detail the financial transactions you're making, that roll up into reports that are then sent around to all the senior people in the organization, right, the board, senior management, and those program directors, then it's really hard again for fraud or stealing to be going on without somebody detecting it, because you have lots of eyes looking, you have lots of checks and balances in your processes, and you have regular discussions about what the financial data is telling you as to about the health and financial operation of your organization. Okay, so that in a nutshell is what I would say is important as it relates to controls. Okay, I guess the other thing I wanted to just touch on here is, and we have a case study this week we're going to look at that talks about, I guess, a breakdown in one organization where fraud stealing occurred, and a discussion of what they could have done to prevent that from happening. Okay. The other thing I just want to touch on for a moment is this week's PowerPoint presentation. There are 2 parts to it. The first one talks about whether nonprofits should strive to make a profit, and the second one has to do with capital campaigns. I just want to touch on that first one in detail. Well, not in detail, but just talk about it for a second. I guess I want to criticize it, so I want to be careful on how I say this. But the speaker seems to equate making a profit with running a social enterprise. And they're really 2 very different things. You can make profit in a nonprofit without having a social enterprise. You can do that in many ways, actually. Probably the easy way is just fee for services, right? You charge for a service you're providing, and you make sure that that relates. You charge for a service related to your mission that has a profit margin in it. That's what colleges do. That's what hospitals do. It's what the YMCA does. So lots of nonprofits do it. Okay. The speaker makes the point that most of those fee-for-service profits are concentrated in the health and education field, and that's very true. So for social service providers, it's harder to charge for the service being provided because the person receiving the service is often not the person who pays for it, right? Uh, so we have child welfare organizations, right? But the child who receives the protection from that agency is not the person who's paying for the service, right? So fee-for-services maybe doesn't work in that case. But I would want to emphasize that you can have contracts with the government, just as an example, that is not a cost reimbursement contract, but a performance-based contract. In other words, the nonprofit will get a certain fixed fee for every unit of service or unit of outcome it achieves. And in those sorts of contracts, well, if the nonprofit performs well, then the reimbursement can exceed the expenditures, hence a profit. So where was I going with all that? Simply to say that you can make a profit without having a social enterprise. And certainly you want to make a profit, you want to have surplus, because if you don't have surplus, how are you going to build liquidity? And without liquidity, you can't prepare your organization for the financial storm, this financial downturn that inevitably comes, and you can't have the independent financial means to start something on your own without going to a funder. Therefore, you do not have organizational independence. All right? So let's just be really clear. You want, as a nonprofit, to generate surplus, because without it, you can't have liquidity, you can't be ready for the financial storm, and you cannot be operationally independent. Okay? So we want profit so that you can build that financial nest egg that gives you all those good things. There are more than one way to do that. That's what I tried to explain here at the beginning of this conversation. Even if you don't run social enterprises, there are ways that you can generate surplus and, quote, profit. But to her whole discussion of social enterprises, she basically throws a wet blanket on the notion, right? And I'll just say in response to that yes, social enterprises come in many shapes, many sizes, many forms, and some of them are a lot harder to make a profit at than others. But I am going to just attach a short article about the NYU Law School, right? NYU's the big college in New York City, and one might in the late 1940s, early 50s, it was groundbreaking in that the law school bought Muller's Pasta Company. And at the time, Muller's Pasta Company was the biggest pasta company in the country. And this was before UBIT. So basically all the profits from the largest pasta company in America flowed into the New York NYU Law School. And as a result of that, two things happened. One, UBIT, unrelated business income tax, was created in the early 50s because companies were complaining that Muller's had an unfair business advantage. It didn't pay any taxes on its profits. Okay, they all flowed into the NYU Law School. Those profits were so great that essentially when the company was sold in the 70s, NYU had a huge windfall of money, and one could argue that it was that windfall of money that actually propelled NYU to be the internationally known and respected university that it is today. So I'll just throw that into the readings today, this week, just for fun, just as a counterbalance to the other piece, the other side of the argument that social enterprises can be difficult to run. But frankly, the whole question of social enterprises requires a whole course. So we really can't get into it. Okay, I see I've talked too long. It's 15 minutes. Lastly, the second part of that video has to do with capital campaigns, and I think we'll talk about that more again next week. Okay, thanks. Call 413-237-7475, and I'll see you online, and hopefully we'll have another good week and finish up strong. Okay, thanks.